During the previous week, U.S. nat gas futures stabilized near their two-week lows, driven primarily by concerns surrounding a surplus in storage and forecasts indicating reduced demand. This drop in demand is largely attributed to decreased feed gas supply to the Freeport LNG export facility in Texas. The count of operational U.S. gas rigs fell to 109, its lowest since January 2022, according to Baker Hughes data. This decline follows a period of natural gas prices hitting a three-year low in February and March, leading to a scaling back of drilling activities. The decrease in production activity is a crucial factor for market participants, hinting at potential tightening in future natural gas supply. Although the new well gas production per rig has been steadily increasing, total gas production saw a decline of 167 million cubic feet per day in April. This decrease stems from older wells experiencing a greater decline in gas output compared to the production from new wells in most regions, except for the Permian region. It doesn't require a genius to recognize that gas output will keep declining, given the drop in production from aging wells and the reluctance of gas companies to drill further until prices surpass $3. In April, nat gas output in the U.S. averaged 98.8 billion cubic feet per day, down from 100.8 in March. Nevertheless, LNG feed gas volumes decreased, with average flows to major U.S. LNG export plants dropping to 12.5 billion cubic feet per day in April, from 13.1 in March. This reduction is partly due to ongoing maintenance and operational issues at Freeport LNG, significantly impacting export capabilities. The overnight data added several heating degree days on cooler trends for April 19 to 23, which could be a reason if prices gain a few cents back. However, it would be more impressive for the bullish case if demand wasn't so light next week and favored to again become light April 24 to 27. Given the current surplus in storage and diminished demand projections, coupled with reduced LNG export activities, the market outlook for the upcoming week leans bearish. However, the reduced drilling activity, the escalating conflict in the Middle East, and potential spikes in heating demand due to colder forecasts could introduce some upward pressure on prices. Traders should anticipate continued volatility with the potential for slight price increases, particularly if production remains subdued and weather conditions drive up domestic demand. In the longer term, as nat gas settles above the 9-week moving average, prices are expected to continue rising, overcoming the $2 level in May and $2.50 in June or July. Thank you for watching. Please don't forget to support the channel if you enjoyed the video. See you in the next one.